Contingency table. Suppose that we're evaluating a mutual fund and that we are particularly interested in the fund's exposure to two factors. The first factor is the company size, and the second factor is whether the listed company is domestic or foreign. Therefore, assuming that the fund has 370 stocks, one way we may construct the contingency table would be as follows. So let's have a look. So remember, there's two factors, or two dimensions, if you will. So the first dimension is company size, so we list that there. And the other dimension is whether the stock is listed in a domestic or a foreign exchange. So there it is. And assuming that we properly categorize all the data points. Remember, we have 370 stocks, which is really 370 data points. And here's the way we organize the data points. So one way to read it: of the 370 stocks, 40 were small cap and listed in the domestic market. And let's pick another example. 110 of those 370 stocks were large cap and they were listed in a foreign exchange. So again, when you add up all these observations, the grand total is 370 data points. Now the information from the contingency table may be categorized as follows. So the first definition or terminology we need to be aware of is joint frequency. So for example, the number of stocks in the funds that are both domestic and small cap is 40. So this number 40 is referred to as joint because you could see that it's these 40 observations have both characteristics, and that's where the name joint frequency comes in from. Similarly, so all these data points, anything here in this data point, or in the table I should say, these would be regarded as joint frequencies. Now marginal frequency, let's do an illustration. It's the total number of stocks in the funds that is domestic is 150. So marginal frequency is referring to these numbers right there. So it's not talking about joint observations. It's just talking about a singular factor observation. So again, as our example indicates here, what does 150 represent? So 150 just tells you the total number of stocks. So remember, there's 370 stocks in total. Of that, 150 are domestic. We're not talking about small cap, large cap, or mid cap. They're just domestic. Alternatively, we could say that of the 370 stocks, 70 are small cap, period. So do you see the difference between joint frequency and marginal? Joint is telling you how many observations exhibit both characteristics, i.e. size and where the stock is located. But marginal just says, just give me the data points that have exposure to this one factor. And that's what marginal is, just that one extra factor, or one factor, if I may. Now, total frequency, of course, is the total number of observations. And there's few ways to find this out. We could just add all these observations inside the table. So these would be your joint frequencies, and that's what we have here. So joint frequencies. So just add those up, it gives you 370. Alternatively, we can find the 370 by simply adding the marginal frequency. So if you're looking at it from the point of view of stock listing, so you can say, okay, domestic, there was 150. So there were 150 stocks that were listed in the domestic market, and there were 220 stocks that were listed in the foreign market. So the sum of the two is equal to the total. So that's looking at marginal frequency from the point of where the stock is listed. But we can also look at marginal frequency in terms of company size. So we could say, 70 were small cap. So these are, remember, these are marginal frequencies. So we can add up the 30, 130, 170, and that 2 would equal to 370. And there it is. So there's your calculations. As a result, contingency table allows us to simultaneously evaluate the impact of multiple variables on the fund. For instance, we could see that the fund is more tilted towards foreign stock than it is towards domestic stock. Let's go have a look at our data, right? So here it is. We know we have 370 total stocks, right? And you could see clearly that majority of those 370 are listed on a foreign exchange. And this is how we pick portfolios, either for ourselves or for our clients, right? We have to analyze what we're getting exposed to by purchasing this portfolio or mutual fund in this case. So this portfolio or mutual fund would be more ideally suited to clients who want more exposure to foreign stocks as opposed to domestic stocks. What else does this contingency table reveal? Well, you could see that, okay, so we've taken care of domestic and foreign. We know it's mostly foreign exposure. How about company size? Well, 70 are small cap, 130 mid cap, 170 large cap. So you could see that this portfolio is more dominated by large caps. And there it is. So the portfolio holds a larger concentration in large cap. So what type of client would this mutual fund be more ideally suited towards? It would be a client who's seeking foreign exposure, and within the foreign exposure, they're more interested in large cap stocks.